Now we will be discussing the import and export procedure. So what basically happens is, say exporter is there in UK. Say exporter is in UK. He goes to the person in charge of vessel, or their officers are there, their agents are there, and he hands over the goods to him and obtains a bill of lading. This bill of lading is basically the title of the goods, which is given to the importer. Now, person in charge of the vessel, they, come to India, then they are bringing the vessel, they file their import general manifest. Same is checked by the customs department. And then the vessel is granted entry inwards. The vessel is granted entry inwards if everything is found. Basically, every entry inwards is everything is found correct. Permission of unloading of the goods. Now here, the goods are unloaded. In the custody of port trust authorities or the custodian of cargo. Custody of port trust authority or custodian of the cargo. The goods are unloaded in the custody of the port trust authority or the custodians of the cargo. Okay. Then what happens? If the goods are unloaded in the custody of the port trust authority, the custodian of the cargo. Now importer electronically files bill of entry. This bill of entry is assessed by, and here this assessed bill of entry, when the department gives, say, order for clearance. This bill of entry can be for home consumption, or this bill of entry can be for warehousing. In case if he wants to clear the goods from the port, he has to present bill of entry for home consumption. If he wants to, say, deposit the goods in warehouse, he has to present the bill of entry for warehousing. Now this is assessed import duty. In case of home consumption, import duty is deposited and they give you the order. Along with the delivery order and this order, they go to the port trust authorities and the custodians, and they get the delivery of the goods. If the goods are to be deposited in warehouse, then we have to execute a triple the amount of duty bond. They give order for deposit of goods in warehouse. Now order is given for deposit of goods in warehouse, then goods are deposited in warehouse. And when we want to clear the goods from the warehouse, we have to again present what? Ex-bond clearance bill of entry. We have to again present what? Ex-bond clearance bill of entry for removal of goods from the warehouse. Okay. So let us see the flow pattern of import. So here the person in charge of vessel or aircraft. The person in charge of vessel or aircraft or any other person notified by central government, they calls on the port, and files the arrival report with the custom authority. They call on the port, they file the arrival report with the custom authority. The custom authorities then check the, the documents. They grant entry inwards to the vessel, assign import general manifest number to the manifest which has been presented, and permit the master of the vessel to land and unload the cargo. Then vessel discharges the cargo into the custody of the port trust authority or any other authority which has been appointed in a particular port to receive the cargo. Then the importer of the goods delivers the negotiable bill of lading from the shipper or the goods to the master or steamer agent, and he obtains the delivery order. Importer makes the self-assessment. Thereafter, he presents the bill of entry electronically, either for home consumption or for warehousing. Then subsequently, in case bill of entry for home consumption is presented, then if the self-assessment made by the the importer is correct, and if he has deposited the duty, then the proper officer will give an order for clearance of goods for home consumption. If bill of entry for warehousing is presented, then the importer has to execute the triple the amount of duty bond, and on such execution, order for deposit of goods in warehouse is given. And on showing the customs clearance to the port trust authority or any other custodians of the cargo, the importer can take the delivery of the goods for home consumption or for deposit of the goods in warehouse. When you want to clear the goods from the warehouse again, then the importer has to again present ex-bond clearance bill of entry. He has to pay the import duty and other charges payable, and then they can be given permission to take the goods from the warehouse. Then section 46 is the important one. That is what we have to present bill of entry. This bill of entry can be for what? It's a basic document for assessment of custom duty. It can be for home consumption. If you want to clear the goods from the port, or it can be for warehousing. If you want to deposit the goods in the custom warehouses, it is bill of entry for warehousing. So the importer of any goods, other than goods intended for transit or transshipment, importer of any goods other than goods intended for transit or transshipment shall make an entry thereof by presenting electronically on the customs automated system to the proper officer a bill of entry in such form and manner as may be prescribed. It may be bill of entry for home consumption, or it may be bill of entry for warehousing. And for this purpose, CBIC has notified bill of entry electronic declaration regulations. In case the electronic filing is not feasible, then the principal commissioner or commissioner may permit the bill of entry to be presented physically also. And here we have to fill up the contents of the bill of entry. And if we do not have full information for, say, preparation of bill of entry, then we can examine the goods prior to the presentation of bill of entry, or even the goods can be deposited in public warehouse. Okay, but we are not presenting the bill of entry for warehousing. Therefore, it is also known as warehousing without warehousing. That is, if importer makes and subscribes to a declaration before the proper officer to the effect that he is unable, for the want of full information, to furnish all the particulars of the goods required. So here the proper officer may, pending the production of such information, permit what? Permit basically him previous to the entry thereof. Permit him previous to the entry thereof to examine the goods in presence of the officer, or to deposit the goods in public warehouse appointed under section 57 without warehousing the same. Then what is the, bill of entry will include all the goods which have been mentioned in the bill of lading. And here, what is the time limit for presentation of the bill of entry? So the importer shall present bill of entry before the end of the day, preceding the day on which the aircraft or the vessel or, say, vehicle carrying the goods arrives at the custom station. So here, if the vessel arrives at the customs station on 25th. So here up to 24th you are required to present what? The bill of entry. So the bill of entry, it must be presented before the end of the day, including holiday. It's not excluding holiday, including holiday, preceding the day on which the arrival, the aircraft or the vessel or vehicle carrying the goods arrives at the customs station, at which the goods are to be cleared for home consumption or warehousing. Here it can also be presented in advance if the vessel is expected to arrive within 30 days of the presentation. A bill of entry may be presented at any time not exceeding 30 days prior to the expected arrival of the aircraft or vessel or vehicle by which the goods have been shipped for importation into India. And in case the bill of entry is not presented within the time so specified and the proper officer is satisfied that there was no sufficient cause for such delay, then in that particular circumstance, the importer shall pay such charges for late presentation. So the late presentation charges basically are 5,000 rupees per day for first 3 days, and then it will be subsequently 15,000 rupees, and that charges cannot exceed what? The amount of the duty. If you remember, if late presentation charges are there, for that also, regulations have been framed. Now, what are the late presentation charges? It is rupees 5,000 per day. The late presentation charges are, say, rupees 5,000 per day for initial 3 days, then it will be 10,000 per day subsequently. However, it cannot exceed the duty element, the amount of the duty. This late presentation charges cannot exceed the amount of the duty. Even if the goods have been made exempted, then also you are required to present the bill of entry. When you present the bill of entry, and if you have paid the import duty, they will give order for, say, permitting clearance of goods for home consumption. Besides this, deferred payment duty is also allowed to certain classes of the importers. So if bill of entry has been presented, say on from first day to 15th day, it is returned to you, then you have to pay the duty on 16th of the next month. And if it is 16th to, say, 31st, it will be what? 1st of the next month, except for March. Duty will be paid by 31st March. This is deferred payment. Regulations have been framed. The duty is to be paid electronically. By whom? They have to pay the duty electronically by the importers who are registered under the accredited clients programs, importers registered under ACP, or say importers paying custom duty of 10,000 or more. Importers who are paying custom duty of 10,000 or more per bill of entry. Then the time limit for the payment of duty. So in case of self-assessment, the importer is required to pay the import duty on the date of presentation of the, say, bill of entry. The importer shall pay the import duty on the date of presentation of the bill of entry in case of self-assessment. And in case if the bill of entry is assessed by the department, then within one day, excluding holidays, from the date on which the bill of entry is returned for payment. Within a day, you are required to pay the duty. Okay? And in deferred payment, as per the due dates which we have said, from 1st to 15th, it is 16th of the that month, and from say 16th to 31st or 30th, it is 1st of the next month, except for the fortnight ending March, where the duty is to be paid by 31st of the March. And if you do not pay the duty, then you will be liable to pay interest at rate of 15% per annum. Now they have also made faceless assessment in customs. Basically, the objective of the faceless assessment is what? Here, there will be anonymity in assessment for reduced physical interface between the trade and customs. There will be speedier customs clearances through efficient utilization of manpower. Then, greater uniformity of assessment across locations and promoting specific sector and functional specialization in the assessment. Now we are having the flow similar to import, we are having flow pattern of export. So here the exporter has to present, say, shipping bill or say bill of export. So the exporter who wants to export the goods has to present shipping bill electronically. That is the application for export of goods. Exporter makes the self-assessment under 17. He determines the export duty, and the export duty export says if any are paid by him. Then the shipping bill is deemed to be filed and self-assessment completed when we have presented the same, that is the electronic declaration in the Indian Customs electronic data interchange system, and this number is generated by ICEDIS. Then the checklist together with the export documents and challans evidencing the payment of duty, and says the same is presented to the proper officer of customs for making order permitting clearance and loading of goods for exportation. After making the order, the proper officer will generate the original copy, that is customs copy, exporter's copy, exchange control copy, and export promotion copy of shipping bills. Okay. Then the original, that is customs copy of shipping bill and checklist will be retained by the proper officer. Exporter's copy, exchange control copy, and export promotion copy will be handed over to the exporter or his authorized person. Then export goods along with the assessed shipping bill, the same will be presented to the preventive officers. They will load the goods in the vessel and they will give the let ship order. Okay, the goods will be loaded in the vessel, and if entire quantity is not loaded, then in that particular circumstance, we have to give a short shipment notice to get the refund of the duty. And if vessel is not, say, anchored in mid-sea because it has not got berth at the port, then it is anchored in the mid-sea, then you are required to follow the boat note procedure. So this was basically, the flow pattern of export. Important from examination point of view. Now this difference between transit and transshipment is asked. Say if a vessel comes from London port, it coats to Kolkata, then from there to Vizag, and then say to Kandla, and goods remain in vessel. Goods remain in vessel to be cleared at Kolkata, to be cleared at Visakhapatnam port, or to be cleared at Kandla port. Then it is known as what? It is known as transit of goods. Transit of goods. It is known as transit of goods. And say, if goods are, say, unloaded from vessel to be loaded in another vessel. If goods are unloaded from a vessel to be loaded in another vessel, it's a case of, say, transshipment. It's a case of transshipment. It's a case of what? Transshipment. In transshipment, vessel changes, whereas in case of transit, vessel remains same. Vessel remains same. So here, what are the statutory provisions? Section 53 of the Customs Act 1962 provides for transit of goods and the conveyance. Section 54 provides for what? The transshipment of the goods. In case of transit of goods, the conveyance remains same. In case of transshipment, the conveyance changes. That is, the goods are loaded from one conveyance, unloaded from one conveyance, and loaded in another conveyance. In case of transit, they are same is mentioned in import manifest for transit, whereas in case of transshipment, besides being mentioned in, import manifest, you have to present what? Bill of transshipment. Is to be presented, or declaration of transshipment is to be given. In case of transit, no supervision is there, whereas in case of transshipment, supervision will be there under of the proper officer. Then no additional formalities are there required for, say, transit, whereas specific conditions are imposed for transshipment. Now, transit is normally allowed at every port. Transshipment is allowed only for specified ports. Then we are having, say, electronic cash ledger. For payment of custom duty. If you deposit the amount, you get the credit when that amount is utilized for payment of duty, interest, penalty, fees, etc. Here, debit is made in this. Beside this, we have ledger for duty credit. So, in foreign trade policy, we are having, remission of duties on taxes on export product scheme, where we get duty credit scripts are there. We get, say, duty credit as per the notified rates, which is credited in the ledger for duty credit, and when the same is utilized for payment of basic custom duty, necessary debit will be made. Okay. Now we are having, say, warehousing. We will be discussing the warehousing provisions also. That is what we can present. What importer, as I already told you, importer can present bill of entry for warehousing. This is into bond bill of entry. Why it is into bond bill of entry? Because we have to execute triple the amount of duty bond. And when you execute this triple duty bond, you get what? An order for deposit of goods. In custom warehouse. Okay. And when we want to clear the goods from warehouse, in case of clearance of goods from warehouse, You have to present what? Ex-bond clearance bill of entry. You have to present what? Ex-bond clearance bill of entry. So here warehouse basically means a public warehouse which has been licensed under 57. It can be a private warehouse licensed under 58, or say special warehouse licensed under 58A. So basically the license is given by the principal commissioner or commissioner of customs, wherein they can license the public warehouses or private warehouses when the dutiable goods may be deposited. Besides this, special warehouses can be licensed by the principal commissioner or commissioner of customs, and these warehouses are locked with the lock of the customs department, and no person shall enter the warehouse or remove the goods therefrom without the permission of the proper officer, and goods notified by CBIC can be kept in the warehouse. And in case if the license can also be cancelled on contravention of the conditions subject to which the license has been given, and if the license is cancelled, the goods are to be removed to another warehouse within say 7 days from the cancellation, or they are to be removed for home consumption or for exportation. We have to execute the triple the amount of duty bond. That is warehousing bond is to be executed, and once you execute the bond, you will get the order for deposit of the goods in what? The warehouse. When you execute the bond, you have been given the order for deposit of the goods in the warehouse. Now this is very important, you remember what is the period for which the goods may remain in the warehouse. What is the period for which the goods may remain in the warehouse? Now here, if the goods are for use in say 100% export oriented unit, or say electronic hardware technology park, software technology park, or say in a warehouse where manufacturing operations have been say permitted, warehouse where manufacturing and other operations are permitted. If whether they are capital goods or whether they are other goods, the capital goods can remain in warehouse till their clearance from the warehouse, and other goods may remain in warehouse till their consumption or till their clearance, and no interest is payable as goods can remain in warehouse till their clearance or consumption. Then in case of goods other than these goods which are for 100% EOU, ESTP, STP, or for manufacturing operations in warehouse, except those goods, the warehousing period is 1 year. The warehousing period is 1 year from the date on which the officer gives an order permitting removal of goods from custom station for deposit in warehouse. So it's 1 year from the date when the officer gives an order permitting deposit of goods in warehouse. Now, though the warehousing period is 1 year, interest will be levied beyond 90 days from the date when the order permitting clearance of the goods have been made. Though the warehousing period is 1 year, interest will be levied after the expiry of 90 days on the duty element at rate of 15% per annum. So, from the expiry of the 90 days till the date of payment of duty, this interest will be leviable. Then we are having baggage. What baggage basically is? Baggage has been defined. It includes unaccompanied baggage, but does not include motor vehicles. Baggage includes unaccompanied baggage, but does not include what? The motor vehicles. Now basically the date for determination of rate of duty and tariff valuation in case of baggage is what? You have to give a baggage declaration. Baggage declaration is to be presented by us under section 77. So the date on which the baggage declaration under 77 is presented, that is the date for determination of rate of duty and tariff valuation. And here, if the baggage declaration is presented prior to the arrival of the vessel, then it will be deemed to be presented on the date of the arrival of the vessel. Now, rate of duty applicable will be here. What is the rate of duty applicable? It is 35%. Besides, on unaccompanied baggage also, the rate of duty is 35%. And if duty-free allowance is not given, rate of duty will be 110% including SWS. If the baggage is not subject to duty-free allowance. Otherwise, the rate of duty on baggage is 35%. Duty is to be increased by social welfare surcharge of 10%, and hence effective rate of duty is 38.5%. Now we are having baggage rules 2016, which is giving duty-free allowance. Rule 3 is in respect of passengers. Passengers who are arriving from countries other than Nepal, Bhutan and Myanmar. They can bring, if these passengers can bring used personal effects, that is to say, things required for satisfying the daily necessities of life but does not include jewelry. Used personal effect they can bring, travel souvenirs they can bring, and articles other than those mentioned in Exhort 1, if they are carried on the person or accompanied baggage. In case of Indian resident, the duty-free allowance is rupees 50,000. Foreigners who are residing in India, it is 50,000, and tourists of Indian origin, it is what, 50,000. Then tourists of foreign origin, the duty-free allowance is 15,000 rupees. And in respect of infants, that is children of not more than 2 years of age, they will be allowed personal effects duty-free. Besides this, if passengers are returning from countries of Nepal, Bhutan and Myanmar, okay, and other than by land route. This is other than by land route. 15,000 rupees duty-free allowance will be there for the Indians residents or the foreigners residing in India and tourists. Okay, then whether it's an Indian tourist or foreign tourist, 15,000 allowance is there. Besides this, if they are returning by land route, they will be getting the duty-free allowance of what? Personal effects only. Then jewelry, if the passenger who is residing abroad for more than a year, passenger is residing abroad for more than a year, he is a gentleman, he can bring jewelry up to 20 grams with a value cap of 50,000 rupees. In case of lady passenger, he can bring jewelry up to 40 grams with a value cap of rupees 1 lakh. Then this was about the baggage. You must remember what duty drawback is. You must understand what duty drawback is. Say, goods are imported, import duty is paid, import duty is paid, okay, then goods are exported, either as such, without use, or say after use. We get duty drawback in that case under section 74. If they are without use, 98% of import duty paid is refunded in form of drawback. After use, depending upon period of use, drawback is allowed, refund is allowed. Then they can be, goods are exported after manufacturing or processing, or say other operations are carried out on goods, In that case, you get a drawback under section 75, either at all industry rate or at brand rate, and if no all industry rate is announced, then special brand rate. So we'll be discussing the difference between the drawback under 74 and drawback under 75. What basically drawback under section 74 is? Section 74 is basically drawback allowable on re-export of duty paid goods. Its drawback is on re-export of the duty paid goods. Here drawback is on materials used in manufacture of the goods which are exported. So under section 74, drawback is in relation to goods exported out of India, means what? Refund of duty, tax or cess, which is paid on importation of goods. Okay? And here under 75, in relation to any goods manufactured in India and exported, means rebate of duty excluding IGST, leviable under 3.7, or GST, cess leviable under 3.9 of the customs, excluding that, chargeable on any imported material or excisable material which is used in manufacture of the such goods. Then under section 74, the goods must be capable of being easily identified. Under 74, the goods must be capable of being easily identified, whereas under section 75, there is no criteria of identification. They say no criteria of identification, since inputs are manufactured or processed before their export. Now here, the drawback will be eligible. Eligibility will be only when the goods are identified to the satisfaction of AC or DC. Here under 75, there is no such criteria of identification. Drawback is available in respect of notified goods. Then under 74, the goods can be taken into use and then also exported. Then also the drawback is admissible. Whereas under 75, if the goods have been after manufacture, they have been taken into use and then exported, drawback will not be available, subject to certain exceptions. Here the goods, exported goods should have been imported and custom duty must have been paid. And in case of 75, the goods exported may be manufactured or processed from the imported material or indigenous material. Under 74, 98% of the import duty so paid is admissible as drawback if the goods have been exported without use. If they are taken into use, then depending upon the period of use, we get the rates. Under 75, drawback is allowed at, say, all industry rate. If no all industry rate is announced, exporter can apply for brand rate. Exporter can apply for brand rate. And in case duty drawback as per AIR is less than 80% of the duties paid on importation, exporter can apply for special brand rate. Now what is the time limit for export here? The goods must be exported within 2 years or such extended time as the board allows. There is no time limit for such exportation. Under 74, there is no requirement of value addition, whereas under 75, either there must not be any negative value addition, and if minimum value addition has been specified, the same must be achieved. Then under 74, there is no requirement to bring the export proceeds in convertible foreign exchange, whereas under 75, the export proceeds must be bought in convertible foreign exchange. Here, re-export of imported goods, drawback of custom duty rules 1995 has been framed. Here, customs and central excise duty drawback rules 2017 has been framed. Then the goods can be exported in form of baggage. Here, the goods cannot be exported as baggage under 75. Now, in case of the goods have been taken into use and then subsequently exported, under section 74, the rate will be how much? Length of the period when the goods have been cleared for home consumption at the time of importation, and when they are placed again customs control for export. So if we have imported capital goods, we have cleared the same for home consumption, then we are again placing these capital goods for export, then 95% of the import duty will be allowed as drawback. Now you remember it's a 3 months show. So not more than 3 months, it is 95%. 3 to 6, it is 85%. 6 to 9, it is 75%. Then 9 to 12, it is 70%. Then 12 to 15, it is 65%. 15 to 18, it is say 60%. So initially it is 95, 85, 75. Then not 65, it is 70. Remember that. Okay? 3 months time span you have to remember. After 18 months, drawback will not be allowed. Similarly, if in respect of wearing apparel, tea chests, exposed cinematograph films passed by board of censors, unexposed photographic films, paper plates and X-ray films, drawback won't be admissible. Under 75, as we have seen, duty drawback is as per the all industry rate, keeping into account what is the input-output ratio, how much duties have been paid. Likewise, they gave all industry rate, and in case if no drawback rate is announced, we get the drawback as per the brand rate, and if drawback rate as per the all industry rate is less than what 80% of the duties which we have paid, we are having say special brand rate. Then we will also be entitled to get the interest in case if drawback is not paid within 1 month from the date of filing of the drawback claim. We will be entitled interest at rate of 6% per annum after the expiry of 1 month till the date of payment of such drawback. And the drawback has to be paid to the claimant if drawback is paid to the claimant erroneously, and the same is to be refunded within a period of 2 months. If the same is not refunded, then you will be required to pay interest, the same at rate of 15% per annum. 15% per annum, and the interest will run from the date of the payment of the erroneous drawback to the date of recovery of such erroneous drawback. So if the same has been paid on 15th of July and it is recovered on 25th of December, from 15th of July till 25th of December, you will be required to pay interest at rate of 15% per annum. Okay? And in case of refund, you will get interest after the expiry of 1 month from the date when your refund claim has been, say drawback claim has been filed. Then there is prohibition and regulation in respect of drawback. You won't be entitled to take the drawback in case the market price is less than the amount of drawback. If market price is less than the amount of drawback, or where the amount of drawback is less than 50. If the market price is less than the amount of drawback, if you are exporting the goods and market price is less than the amount of drawback, you won't be getting the drawback, or where the amount of drawback is less than 50, or in case the goods are likely to be smuggled back into India, then you won't be entitled for drawback until and unless you prove that the goods have been say actually exported and they are not say smuggled back. Then if you violate the provisions of the Customs Act, then that will lead to what? Improper importation, leading to what? Penalties. So this is just a list. I don't think so this will be asked in your introductory level, but penalty, you must remember that in case of prohibited goods, penalty can be not exceeding the value of goods or rupees 5,000, which is higher. So in case of dutiable goods, penalty will not be cannot exceed, not exceeding what? 10% of the duties ought to be evaded, or 5,000 rupees, which I say higher. But in case if you pay the duty amount along with interest and penalty within 30 days from the date of communication of the order, then penalty will be 25% of the penalty so determined. So if duty amount is 25 lakh rupees, maximum penalty here in case of dutiable goods can be 2,50,000 rupees. But if you pay this duty along with interest and penalty, then penalty will be what? 25% of 2,50,000, that is the same is paid within 30 days. Then in case if the value stated in the bill of entry or say baggage declaration is greater than the actual value, then you are required to pay penalty of the difference between the declared value or rupees and the actual value or rupees 5,000 which is greater. So you can go through once. Prohibited goods, the penalty will be prohibited goods and where the value declared is higher, penalty will be the actual value, difference between the declared value and actual value, or 5,000 which is higher. So if it's from first, this is from third, and this is common. Then here, in case of dutiable goods, not prohibited goods, where the value stated in bill of entry is higher, you will be required to pay penalty of what the duty sought to be evaded, difference between the declared value and the actual value, or 5,000, which I say highest. Then we are having refund of export duty if goods are exported. Export duty is paid and then they are say goods are re-imported, otherwise than by way of resale. Otherwise than by way of resale, they must be re-imported within 1 year. They must be re-imported within 1 year. Then we will get what? The refund of the export duty. We will get what? Refund of the export duty. So here any export duty paid on exported goods will be refunded. The goods are re-imported within 1 year. The goods are returned otherwise than by way of resale, and refund claim is to be made within 6 months from the date when the proper officer makes an order. Export duty has been paid, goods are returned otherwise than by way of say resale. Goods are re-imported within 1 year. Then refund of import duty in certain cases, say goods are imported, import duty is paid, but the goods are basically found to be defective, or say they are not in conformity with the specifications, and they are either re-exported, they are exported, or importer relinquishes the title, the goods are destroyed or rendered commercially valueless. Then whatever import duty has been paid, the same will be say refunded. So basically this section applies when say duty has been paid on the importation, the goods are capable of being easily identified, and the goods are found to be defective, not in conformity with the specifications, and the goods are say identified to the satisfaction of AC or DC that the goods have been exported, the goods were imported, and importer does not claim drawback, and goods are re-exported, importer relinquishes his title, goods are destroyed or rendered say commercially valueless within a period of say 30 days, then extension can be granted up to 3 months. If you fulfill these conditions, you will get the refund of the import duty, and here the application is to be made within 6 months from the relevant date. What is the relevant date? If you export the goods, the date when the proper officer gives an order for clearance of goods for exportation. In case if you relinquishing the title, the date when you relinquish the title. If the goods are destroyed then or rendered commercially valueless, the date of destruction or when the goods have been rendered commercially valueless. However, refund will not be granted in case offence appears to have been committed in respect of the goods, or goods are say perishable in nature. Then there is a concept of advance rulings. As you are aware, the applicant can take an advance ruling. If he is not aware with the laws of India, then applicant basically means a valid say person who is having a valid IEC, he is exporting any goods to India with a justifiable cause to the satisfaction of the authority. He can make an application for advance ruling. The advance ruling will be pronounced within 90 days of the receipt of application. If the application is made, same can also be withdrawn within 30 days. The ruling so pronounced will be binding on the applicant in respect of the matter in which the ruling has been pronounced, as well as on the departmental authorities. To settle the disputes, we have what? Settlement Commission, and we can go to the Settlement Commission. Our additional custom duty must exceed rupees 3 lakh. So you have an idea about what? You have to make a true and full disclosure which has not been disclosed before the proper officer, pay the duty along with the interest and go for settlement. Then Settlement Commission will pass the order. We have already discussed the practical questions relating to the, valuation and classification aspects. Now let us discuss one practical question relating to baggage. Mr. Devendra is an Indian entrepreneur. He went to China to explore new business opportunities. So he is an Indian resident. He went to China on 5/4/22 and he has returned back on 20th of February 23. Now he has brought two music systems worth 23,000 rupees. So music systems, they are not basically in the restricted list. So he will get 46,000 is the value of music system. Jewelry, this will be accommodated in general free allowance, 49,000 rupees. Rule 5 benefit will not be available. Why? Because he is not residing for a period of more than 1 year abroad. You will be getting the benefit of Rule 5 duty free allowance in respect of jewelry when you are residing more than say 1 year. Now they are asking us the eligibility. So here this is 95,000. Duty free baggage of 50,000 allowance will be there. On 45,000 rupees you will be required to pay duty at rate of 38.5%. So here on 45,000 you will be required to pay duty of 38.5%. So this was all about overview of customs. Basically focus must be on valuation. At least rule 10(2), this practical question we have discussed, you must focus on valuation. Practical question can be asked for 5 marks from valuation. So this was all about the overview of customs which we have discussed here.